We're coming off of a great May where we're matching the best results since 2023, Greg. But once again, it's the trade tit for tat that has thrown a monkey in the works here.
Yeah, the trade is doing a lot of heavy lifting here, but there are other factors as well, Contessa. When you look at the recovery from Liberation Day, one of the other factors was earnings growth. Earnings growth surprised to the upside. The January 1st expectation for S&P earnings growth was 11%. The March 31st expectation was 7.9%. And we've seen the S&P achieve 12.9% earnings growth. Of course, the president's trip was designed to be a shot of short-term optimism into the market. And so it was not just a dovish retreat and more conciliatory language that led to that recovery in the markets. As you rightly intimate, it looks like the catalyst of a more dovish posture on trade is going away, but so too are some of those other tailwinds.
When you're looking at healthcare, which was weaker in May, you're looking at crude prices now going higher, even though OPEC has said it's going to raise production here. Give me a sense of how you're thinking about June and going into the summer months and where you should be positioned.
So what I think we'll see in June, and I want to caveat this by saying that I'm optimistic that this year looks a lot like 2023, where we see a back-end loaded performance. Remember, in 2023, all the performance occurred from October 27th on. And so that caveat sets up what I see as a very difficult summer. I think we're going to retest those April lows as we see inflation and the current tariff policy, much less the future tariff policy, make its mark. The regional PSIs and the ISM data spell this out quite clearly, where we've seen costs rise at a faster pace than we've seen since 2022 for manufacturing and 2023 for services. And so I would buckle down and prepare to see better entry points on the things that we see have a structural tailwind for long-term earnings growth, because in the short term, when we see these, what has been tailwinds reverse, these tailwinds over the last 2 months in terms of inflation, in terms of a Fed that is certainly not going to cut rates, and in the concern of GDP shrinking, I think the markets will take a more sour outlook.